Hi, I'm Pattu from freefincal. Today let's take a look at Nippon India Passive Flexicap Fund of Fund. If I'm not wrong, at least two viewers had repeatedly asked about this fund. Maybe it's the same person, I'm mistaken, but I had several comments about this fund. I don't know what's really special about this, but the name says it's a passive Flexicap Fund of Fund, which means that it's going to invest in ETFs or index funds of Nippon India, and the whole idea of this fund is to basically invest in a large cap, mid cap, small cap ETF or index fund of Nippon India. That's the basic investment strategy. The asset allocation they will decide as per market conditions. It's not the asset allocation itself is a little bit flexible, but what you should be worried about is if you are looking at this fund, considering this fund, is what are the underlying funds and are they ETFs, how liquid they are, and so on. So on the face of it, everything looks good, right? It looks like, okay, I don't need to, I just have one fund, I'll just buy that one fund, and I have basically a portfolio created. I don't need to worry about separately investing in a large cap index fund, mid cap index fund, small cap index fund. I can just buy one fund and it'll have everything. On the face of it, the packaging looks good, but you have to look closer. So if you look at the portfolio, this has been the portfolio since its inception. So this is January 21. The fund was started in December 2020. So you can see it's been holding, it has held 42, 29, 26% of mid cap, large cap, mid cap, small cap, and then it reduced its small cap from May. In April it held 29% of small cap, and then it reduced it to 9%, and it increased it in large cap and so on. So the three funds it has been holding is Nippon India ETF Nifty 100, Nippon ETF Mid Cap 150, although they have a mid cap index fund, and then they have a small cap 250 index fund. Those are the three funds. Everything looks nice and good, but you have to look a little bit carefully. If you look at the ETF has only 165 crores, and if you look at it, it's holding about 68-69%. So 68-69% of the ETF's AUM is held by this fund alone, and that means that there are not too many other investors in the ETF, and which means that there will be a significant price to NAV deviations. And you can see that even casually, if you go to value research and look at the plot, look at the chart, you should see significant price NAV deviations. Now, what we should understand is when when a fund of fund invests in an ETF, initially during the NFO period, they will collect some AUM and then they will put it directly into the ETF. Directly means they will buy directly with the AMC. They will buy the ETF at the NAV price. That is the NAV value from the AMC. But after that, on a day-to-day basis, every day that much AUM will not come. Some days no AUM will come. Some days little bit AUM will come. Some days little bit AUM will leave. Then the fund of fund will be one more investor in the ETF pool, and they have to trade, buy and sell the ETF just like any other investor. So which means that the price fluctuations of the ETF will determine the returns of the fund of fund. So if the price fluctuations are significant, then obviously the fund of fund will also suffer. Now this is something that investors should understand, and especially look at this. It's a majority is basically owning that ETF. It's like if that Nifty 100 ETF was a company, this passive fund of fund is basically the owner, right? It's taken over that ETF since the last 6 months because of its AUM. This is unhealthy, and you have to look at that. I've been saying this for a very long time. Look at the tracking error with respect to the price and not the NAV. Now, if you look at the movement between January 4th, 2021 and September 3rd, 2021, the price movement in the ETF, the absolute gain is 31.5%, whereas the change in the underlying benchmark is only 24.4%. Look at the difference. Look at the huge tracking error there. Today, you will say, I've got 6% more return, but tomorrow that can be 6% less return also. So that's the risk. I mean, the change in the NAV is only 23.84. The change in NAV of the ETF is 23.84. change in price of the ETF is 31.50. This is what I keep saying is a big risk when you invest in an ETF or you invest in a fund of fund. It's better to avoid this as much as possible. And that ETF can have 0% expense ratio. It doesn't matter. People are always looking at cost. Look at the actual risk of investing. 0% expense ratio ETF can have wild price now fluctuations. Then you will suffer. You will get that loss in your portfolio. So, and also I have made it clear several times, don't touch mid cap or small cap index funds or ETFs. They will have severe tracking error because our markets are not at all liquid. Beyond the top few stocks of the Nifty, the liquidity is not there. I have said this several times. The impact cost is there in the market. That is, impact cost means if you take some stock which is let's say in the bottom 10 of the Nifty 100, selling or buying that stock, 10 quantities of that stock, you will get one buy price and sell price. If you try to sell 10,000 quantities, you will get a very different buy price and sell price. So the buy price and sell price will differ by a huge amount, and that's called the impact cost. This has got nothing to do with expenses and so on. This is the market liquidity at play, and our markets are not at all liquid. And you want to buy a passive fund of fund just because it looks enticing. Oh, it'll invest in mid cap, it'll invest in small cap. It's just nonsense. Please stay away from this. There's nothing in it.